Lalit Thakkar of Angel joins us right now with his sense of how the markets are shaping up and what we will do in the near term. Lalit, good having you, and thanks so much for taking the time out today, Lalit. What explains this kind of nervousness today? Is it possibly because of the fact that we are up to a very important decision coming up in a couple of trading days' time? Is it because of the market realizing late that the results had been great? Or is it a combination of a lot of factors?
Yes, I think it is multiple factors which has now finally exerted pressure on the market. So to start with, our market, which was trading at 4600 level, it got lifted to 5600 level, especially because of the FIS inflow. And that's why got a humongous inflow we saw in this January-February period, which was unsustainable. So naturally, the market had to come down. So that's the reason, one of the reasons why market has come down from this 5600 level to around 5200 level. But now, having said that, there are no positive factors right now looking at the market. If you look at the market for the time being, the starting point is GAR, which still is an overhang on the market. The clarity is not there. Secondly, the earning momentum also is not expected to go up in this year. And third, I think the main reason was the currency depreciation. Because of the currency depreciation from 49 to 54, FIS, any foreigners is now seeing a hit of 10% on their portfolio. So that's the reason I think all these factors have pulled down the market, and that's one of the reasons. This is the main reason. And now of late we know that Indian markets are slightly tad expensive than the other emerging markets. If you especially compare with China, which is trading at around 11p, and Indian markets are trading at 12.5p. So nothing positive looking on the horizon for next 6 months. That's the reason the market cannot remain at a stable level. It has to find some way out. So probably this 5160, 5160 support has given away. This was a level which everybody was looking at. And since the support is broken, that's why we are seeing a market coming down very sharply from these levels.
But what would be your strategy at this point, Lalit? Would you wait on a bit more before buying, or it's not bad to accumulate at every fall?
See, if anybody is looking from a 6-month perspective, possibly there are not no great positive triggers. But having said that, if you take in 1 year horizon, a lot of interesting things can come out. To start with, GAR a lot of clarity can come on GAR. Currently, I don't think anybody should get swayed into these red earrings. One should wait for the final print. And I think looking at poor FIS inflow, there's a good possibility there will be a lot of relaxation on the GAR front. And secondly, as the time goes by, we'll be starting looking into FI 13-14 numbers rather than 12-13 numbers. And of course, we perfectly understand that interest rates are not going to come down in another 1 quarter, but possibly in the second half we are going to see at least 75 basis point to 100 basis point cut. So all this will, on account of all these things, we will see again the earning momentum going back to 15-16%. See, actually, if you look at India, the hallmark of India is always the high earning growth and high GDP growth rate. So if you are able to go back to 15-16 earning momentum, which is very much possible because our top line growth are still 15-16%, I think again the interest will come back. But yes, if you are talking from a 3 months or 6 month perspective, probably market may say that we will take our own time to give a thumbs up to all these positive turnarounds. But having said that, on a 1 year horizon, we are very optimistic from the current levels.
What comes into this optimism, Lalit? Because if we're talking about earnings, if you look at the current quarter, there have been more disappointments than positives. I mean, a TCS got a thumbs up because of what Infosys did, and it got hammered down in trade, of course. Some of the banking names and the results have been horrendous out there. And take into account what's happened to telecom per se on the policy front as well, or the results front, it hasn't been too surprisingly on the positive side at least. What fuels this optimism?
I agree with you. This March earning has been a washout, and possibly for the full year we are going to see tepid earning growth of around 12-13%. But having said that, I think we need to now look beyond that. That's the reason we are confident about. And secondly, one interesting point I want to highlight is that if you look at the export growth of India, it has come down significantly last month or last quarter, but that has been the case for all the emerging economy. I think this must be on account of slowdown on fear on this eurozone, and probably probably companies must have cut down on inventories. So if you see the overall export growth, which was 24%, has come down to 25% in the last month. But having said that, because we are seeing a reasonable amount of clarity on the Eurozone, so we are expecting export to go back again, the interest rates to come down in the second half, and because of all these reasons, we feel that earning momentum can be about 15-16% for the year FY 13-14. As I said, that if your top lines are 13-14% growth rate or 15% growth rate, your earning momentum cannot be lower than that. On account of all these things, I feel that again we'll be back to 15-16% earning momentum trajectory from FY 13. Of course, it is slightly early to discount FY 13-14, but probably from second quarter onwards or third quarter onwards, market has to now look at 13-14. So at that point of time, if the EPS of the Sensex is going to be around 1475, then give a 14-15p. So we can expect a good 15 or 20% upside from the current level. This is from where we are getting the confidence.
Right. What about rate sensitives then, given where we are in the rate cycle?
See, I personally feel that interest-sensitive sector will do better. So, for example, if the interest rates comes down, then definitely the real estate sector will get a boost up, the automobile sector will get a boost up, and if your country's GDP, which is right now at granted at 6.2 level or 6.3%, if it goes back to 7.3%, then capital good industry also will see a comeback. So, on all these fronts, that's why we expect this interest-sensitive or cyclical business to do well in the coming times. But having said that, you cannot do away with the defensive sectors also, because since the rupee has depreciated a lot, you are going to see IT sectors to do well, the pharma sector to do well, the export sector to do well. So all in all, in some sectors we'll have top-down approach, for example in the case of capital good industry and IT, and somewhere we will have, in some cases we'll have a bottom-up approach in the banking industry, where we like private sector banks.
Okay, Lalit, would you buy into the weakness that we are seeing in, say, maybe a Hero MotoCorp, which came out with not the best of guidance? So it's not just about the earnings that came in, but the guidance for the new year as well hasn't been that great. So would you buy into that weakness, a Hero MotoCorp or a couple of banking names where again the numbers and the commentary has been too positive? A Bank of Baroda, for example.
See, coming to the Hero Honda, I won't read too much into this monthly numbers. What I understand is that if you look at the penetration of two-wheeler in India and compare it with other emerging economy like China, we have a lot of room to go up. Probably the penetration over there is 3 times higher of India. So mainly last year was not a very good year for our economy, but still our two-wheelers growth rate was around 15%. So I think there is a lot of steam left in this two-wheeler sector. So we can continue to see a volume growth of 10-15%, and if I'm getting a stock at around 13-14p, which is in line with the Sensex valuation, I would like to give a shot to it. So Hero Honda, we find it attractive at this level. Now coming to the banking sectors, we personally are having, our leanings are towards private sector banks on account of multiple reasons. To start with is the quality of the asset quality. You can see the difference between PSU and private sector bank, and additionally because PSUs cannot go for dilutions because government wants to keep in 51% holding on it. So whenever there is a growth opportunity, the interest rate is the private sector bank which can capitalize on it, and especially after the Basel III, if for any reason there is more capital requirement in the industry, I think the private sectors are well placed in the PSU space.
Right, will you take a contrarian position in cap goods right now, Lalit, given the correction valuations that we've seen in stocks such as BHEL, L&T? Yes, we are very positive on the capital good industry, but not the BHEL, because BHEL is having a very high market share in this power equipment segment. At the same time, their EBITDA margins are 18-19%, and in this industry, usually you cannot enjoy more than 11-12%. So BHEL, we had been neutral for a very long time, for the last 2.5 years, where our tone was always negative. At the same time, we are positive on the Larsen, because this company still can grow higher than the industry, and if you look at the valuations, the inline valuation of the Sensex. So we are positive on capital good industry, especially Larsen, and then other stocks like Crompton Greaves, Blue Stars and Voltas.
Lalit, finally, before we let you go, really, just one quick word on the consumption theme. Everybody speaks about consumption stories still holding strong, there being good defensive plays. Valuations are fairly rich. So while the numbers have been good from companies like HUL, the mid caps are trading at substantially high PEs. Would you use this market weakness to reduce some positions if you had them, or you would still stay bullish on the consumption names?
No, in the FMCG space, I think some of the stocks which are trading at reasonable valuation, for example, around 25p, I would like to reduce my exposure. So still, I think Hindustan Lever is a buy, ITC is a buy. But at the same time, if there are companies like Nestle which are trading at 35p, no doubt their volume growth is also higher than the ITCs and the Hindustan Levers of the world. But I'm not comfortable buying stocks at 35, 40p. But at the same time, if FMCG company are trading at 25p, the stocks like Hindustan Lever, ITC, and Godrej Consumer, which is around 21, 22p, or Marico, I think they also deserve a position in the portfolio.